strategy for your business.
You're very welcome back to Breakfast Business with me, Vincent Wall. Now, it won't come as a surprise to people trying to buy houses and apartments for their own use that investors are playing a very significant role in the residential property market, particularly in Dublin. According to Savills Investment Market Review and Outlook 2015, a particular type of investor has been particularly active. Those involved in so-called multifamily investment deals, where more than 20 units are purchased at any one time. In fact, more than 4,000 residential units in Dublin have been sold as multifamily over the past 2 years, equivalent to 17% of all sales. John McCartney is Director of Research at Savills.
Well, I think actually both sides of it are surprising. I mean, when we totted up our residential resales figures for the end of 2014, what we discovered was that 26% of all our sales to individuals walking in off the street were sales to investors. So investors are a big part of this retail market. Ordinary individuals coming in and saying, well, look, I've got a certain amount of cash. I'm not getting much of a return from the bank on that cash, so I'm going to find something else to do with it. And that's finding its way into bricks and mortar. We know now that that's the case. But aside from that, and running in parallel to it, is this phenomenon of multifamily investment.
That's where more than one apartment unit is bought.
Yeah, technically we consider something to be a multifamily investment when more than 20 units are bought in a block. And over the last 3 years, the beginning of 2012 to the end of 2014, we saw more than €700 million invested in this type of property.
Why is that happening?
Well, it's really happening for a number of reasons. Firstly, on the demand side, there's just such a scarcity of housing that rents are going up, and that's driving up yields. And as a result, investors are seeing a return on this. And that will continue to be the case as long as we have, I suppose, a low vacancy rate in the private rented sector. And that's going to be the case until we start building more properties. So that's one side of it. On the other side of it, there is the supply. Following the economic crash, there was this overhang of these vacant blocks that could be bought in their entirety. And what happened then was that these international players that had been involved in large-scale residential investment in other countries came in and saw an opportunity to hoover up these big blocks of vacant property and get them all at a discount because they were buying in scale. And as a result, they're now investing in these properties and holding them on a long-term basis. So
do you think that trend is going to continue and grow this year and in the years ahead?
Well, I think the demand side is certainly there. I think the issue that we're seeing is that the overhang of these vacant blocks is no longer with us. A lot of them have already been bought up, and as a result, these investors are increasingly having to settle for fragmented ownership, so they're buying maybe 60% of the units in a given block. And that's, I suppose, slightly less appealing from their point of view because it doesn't give them the same opportunity to set the tone of rents within the development, because obviously if you only control 60% of the units, then the other 40% of landlords can come in and set any rent that they want, and if they happen to set a lower rent than the one that you want to go with, that then has an impact on your income generating potential. So we do think that it will be a part of the market, but I think we're going to see we're going to see it change. The other side is that as house prices increase, some of the players that came in and bought fragmented blocks may be tempted to break those up and sell them off as individual units and get their money back quickly that way.
But for individuals, particularly first-time home buyers looking out there in the apartment market, is it going to get tighter? One, because of the constraints now imposed by the central bank in terms of loan-to-value, and two, because there are these huge investor interests out there looking to buy up whole blocks of units.
Well, I mean, I think there's no doubt that the central bank rules are going to make it harder for first-time buyers, particularly single people in Dublin, to get onto the housing ladder, and as a result they're probably going to be redirected into the private rented sector, and they're going to stay there for longer. So in a sense, those new rules do create a captive market of tenants for landlords to tap into. In saying that, ultimately, I don't see the value in juxtaposing, landlords against owner-occupiers. Ultimately, landlords are providing a service to society because they're creating the supply side of the rented market, and if we didn't have them, there would be an even worse shortage of rented accommodation, and rents would be even higher. So I think what we ultimately need to do is we need to build more properties so that there's both an availability of rented properties and an availability of properties to buy, because at the moment the problem is that if the landlords take more of the properties that are on offer, then it leaves fewer properties available to homeowners and owner-occupiers, and we have this sort of nil-sum game, and that's really the problem. What we need is enough properties to service both tenure types.
John McCartney of Savills. To market developments now, and we're joined on the phone this Monday morning by Paul Somerville of Somerville